So this week we had another Fed announcement, and they decided to leave the Fed funds rate unchanged. But what was more interesting to me is what you see there on your screen, what Jerome Powell said in the Fed Q&A after the Fed meeting. So he said a number of things. There were comments out about the Fed balance sheet. There were comments out about the coronavirus. There were comments out about inflation. The Fed is worrying about a lot of things. There's been a bunch of different interviews lately from different Fed members over the last month, and we could go back a month on this, whether that's an article from almost a month, January 3rd, from Jeff Cox, that some Fed members worried that keeping interest rates too low have encouraged too much risk-taking. The December Fed minutes are showing. So I have an article on that. Well, duh. I mean, if you know Austrian school economics, you know that manipulating interest rates causes unbelievable distortions in the economy. Only years later would the Fed actually, the Keynesian economists who have common sense bred out of them, would actually figure that out. There was another article from early January 4th, talking about how the Fed is worried about the corporate debt market. A member of the Federal Reserve in a panel discussion at the Brookings Institute talking about leveraged loans, collateralized loan obligations, and corporate debt. And also recently, part of the yield curve started to invert again. So not the whole yield curve, just a tiny little part of it as of right now. I think the 3-month yield is slightly above now the 1-year yield. So the 3-month yield, let's see here. Yeah, the 3-month yield is 1.56 and the 1-year yield is 1.51. Another thing the Fed is worried about is the dollar index. The dollar index is stubbornly above 97. The Fed doesn't want it there. The U.S. Treasury doesn't want it there. President Trump definitely doesn't want it there if you pay attention to his Twitter for months now, for over 6 months now. And the dollar index right now, when we're doing this live stream show, is at 97.91. The trade-weighted dollar index is kind of in a downtrend now. It's at 128.65, 39. So it's in a little bit of a downtrend on the 1-year chart. Let me look at the 5-year chart. On the 5-year chart for the trade-weighted dollar index, it looks like it's hitting one of the, it's looking like it's below a support level, but it's tough to tell if it will stay that way. So the trade-weighted dollar index may be in a correction, but the regular dollar index is actually strengthening. It was above 98 earlier this week. I can't remember if it was yesterday or the day before, but the trade-weighted dollar index briefly was above 98, and it's almost at 98 again. It's stubbornly staying quite a bit high, and this fits in for now with my short-term dollar tug-of-war thesis. If you have not seen that, listen to that audio. Go back and listen to that from earlier this month. It came out right after January 1st. It might have been January 2nd. It could have been January 1st. I might have done it hungover. I can't remember. It's January 1st or 2nd. I did go to a New Year's Eve party after all. And so there's a lot of forces pulling on the dollar, and this is why, despite the best efforts of the Federal Reserve, the U.S. Treasury, and President Trump, they can't get the dollar down to the levels they want it. Also, since today was Thursday, we have another Fed official balance sheet update, but I think there's red flags there starting to dislocate. The official Fed balance sheet is really starting to dislocate from the repo numbers. Some of my friends that pay attention to all the repo numbers, like George Gammon and my friend Wayne, who entered this into Excel spreadsheets or software programs, scripts that they write to track this every day, there's starting to be a dislocation now between the repo numbers that come out daily, and there's still a good amount of repo every day, and the Fed's balance sheet. So the Fed's balance sheet now has not really moved very much in the last 2 or 3 weeks. It's been stuck in a trading range between 4.149, blah, 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 blah. 4 point is almost as bad as the flub I had on the audio recording where I said that the Spanish flu epidemic was 1913 and not 1918. I'm a history major. I should know better. I had to look that up afterwards. Whoops. Oh, well. $4.149 trillion and $4.175 trillion over the last 3 weeks. So the Fed's balance sheet has been in a trading range despite the amount of repo. And remember, my thesis now with the repo market is, I'm paraphrasing Kyle Bass's "A rolling loan gathers no loss." And Kyle Bass normally says that about the Chinese bond market and Chinese credit. Chinese credit that's defaulting, all the problems in China. And I've added that to repo, and it's a perpetually rolled over term repo, gathers no loss. So George Gammon is doing a superb job covering this with the U.S. side of the repo market, how a lot of the collateral now, I believe it's way over 50%, is mortgage-backed securities. And also, I'll add that a lot of these repos have gone from overnight repos to term repos. So these term repos should be showing up on the Fed's balance sheet, on the Federal Reserve's official balance sheet, and it doesn't look like they're showing up on the Federal Reserve's official balance sheet as an increase in the last couple weeks, even though the Federal Reserve is adamant that the repo will continue through at least April, tax season, which means that we are going to have the first repo madness or reefer madness, depending upon how you want to look at it. And hopefully we'll get some nice Wall Street for Main Street fan art there with a goofy reefer madness or reefer repo madness fan art background with some marijuana and maybe some unicorns and Crazy Eddie repo madness there, or a pawn shop in the background. That would be pretty funny. Okay, so I wanted to talk about inflation. So the Fed is obsessed, according to this new article from Brian Chapata of Bloomberg that came out on January 29th, 2020, very shortly after the Fed announcement on Wednesday. The Fed is obsessed that they cannot get inflation above 2%. And remember, I've been talking about this for weeks now. You have Federal Reserve Board of Governors, you have former Fed economists that are making the big bucks, even bigger bucks, now at hedge funds and consulting gigs and think tanks to Wall Street. And some of these guys want the inflation target switched to 4%. So they're saying that the official inflation target of 2% is not enough. The Fed needs to go to a 4% inflation target. And so far, Jerome Powell has said his official comments have been, well, we need more inflation, but we don't want to go shoot for a 4% inflation target. So they'd like to see what that means to translate through all the gibberish is that they'd like to see the official government inflation rate above 2%, but not at 4%, because they know that that would be doubling the inflation rate, the official inflation rate. Obviously, on Main Street, the real numbers are much, much worse. If you look at the Chapwood Inflation Index or Shadow Stats, the Chapwood Inflation Index builds upon John Williams of Shadow Stats' work. So let me talk about this 2%, how the Fed is not getting the 2% inflation. In case it wasn't obvious before the Federal Reserve's January meeting on Wednesday, it should be crystal clear now. The central bank is obsessed with inflation. One of the only changes to the Federal Open Market Committee statement was the following. The committee judges that the current stance of monetary policy is appropriate to support sustained expansion of economic activity, strong labor market conditions, and inflation returning to the committee's symmetric 2% objective. This was intentional. Chair Jerome Powell said during his Q&A after the statement was released that the goal of that tweak was to, quote, send a clear signal that we're not comfortable with inflation running persistently below our 2% symmetric objective. He added, we're not satisfied with inflation running below 2%, particularly at a time such as now, where we're a long way into an expansion and a long way into a period of very low unemployment, when in theory inflation should be moving up. And the velocity of money is not accelerating. So this is stagflation. The real economy, and I've been talking about this for years, is stagflate and tax and lie. The government numbers are probably never going to reflect this reality of worsening stagflation and taxes and lying. And by lying, I mean propaganda, economic data. Economic propaganda. That's what, lying through data. So all these governments, whether it's China, the European Union, Japan, the US, all lying about inflation. And then they don't count taxes. So if taxes go up, they don't count that, but your standard of living's collapsing with a higher real inflation rate and taxes being layered on. Okay, but back to the article, but even more tellingly, Powell made a clear, concise argument during his opening statement about exactly why the Fed is so determined to see inflation run hot in what could very well be the consensus view among policymakers. While low and stable inflation is certainly a good thing, inflation that runs persistently below our objective can lead longer-term inflation expectations to drift down, pulling actual inflation even lower. So they're worried about inflation expectations. They want people to spend money. They do not want people saving money. This is the problem with Keynesian economics, the paradox of thrift. So they are worried about if They want people to spend money. When there's higher inflationary expectations, that means people spend more money. That means there's more velocity of money. So that's what one of the things they're trying to get. The other reason they want more inflation, obviously, is to deal with the national debt. They also want a weaker dollar. So they want to devalue those unfunded liabilities, the U.S. national debt, which is growing at unbelievably large levels. There was a bullshit CBO projection that came out recently. I think they said by 2030, the U.S. is only going to have a $30 trillion national debt. I mean, the pace we're on, it's going to be a lot larger than $30 trillion by 2030. So if you want to read more of the article, I'll put it in the information and description section. But there's a lot of things the Fed is worried about right now. Powell made some very interesting comments about the coronavirus. He said it's significant. Also, like I said about the yield curve threatened to start going inverted again. It didn't fully go inverted yet, but if that happens, I suspect. Now, the Fed is telling the market right now that they will not do rate cuts, but I suspect if the yield curve goes inverted again, I expect that the Fed could very quickly go into cutting mode. That cutting mode will accelerate. So as of now, they're telling the market to not expect a rate cut for 2020. Obviously, the Fed has a very horrible track record of making predictions about rate cuts or not. Normally, it's way, way off on that. And the Fed balance sheet has stopped growing. Despite that, we're still doing repo madness. So I think there's a big disconnect there because for the last couple weeks now, the Fed's official balance sheet has been stuck in a trading range. It got as high on January 15th as 4.175 trillion. Well, if we round up, it's a little bit more than that. But it's been in a trading range now for the last 2 or 3 weeks, despite the amount of repo. And also, supposedly, the Fed is still buying $60 billion per month in treasuries. So that $60 billion per month in treasuries the Fed is buying should increase the balance sheet again soon, along with the repo, and it has not in 2 or 3 weeks. So that's very interesting. We'll have to keep track of this. But at some point, if the Fed's official balance sheet is not going up, despite what we know about the $60 billion per month, the not QE program, and the amount of repos that are still ongoing, and a lot of those repos are term repos, the Fed's official balance sheet's not going to have any meaning whatsoever. I mean, I don't trust the numbers, but more market professional money managers should not trust the numbers either, although I doubt they will do that. Because they're paid to trade on these numbers. They're paid to invest, and I'm using air quotes, invest. The investments now are all short-term. They're paid to invest and trade only on short-term numbers. You know, it's interesting, with all of this news, the dollar collapse, people are like, the dollar should be lower, the top was in the dollar is going below 97, it's never going to get, the dollar index is going below 97, it's never going above 97, the overhead resistance, it's now, the overhead resistance level is there now, all the stuff the Fed's doing, the dollar index is not going above 97.16 ever again on the dollar index. I was hearing that like 3 weeks ago. And here we are. We were above 98 this week. So again, there's forces pulling against the dollar that people who are rooting for the dollar to fall and want the dollar to fall don't want to hear. Okay, I'm a big fan of gold. Gold's going to do very, very well in this environment, but the dollar is not collapsing, at least not yet. Gold price is holding up very, very well. 1,578 around, and silver's not as well. Silver's struggling to stay above 18 at 1783. So that this is all the different levers the Fed is pulling. The Fed is pulling all these levers. Of course they're going to make mistakes. Of course they're going to screw up. But unlike you and me, when we make a mistake and we have to pay very, very hard for it, bankruptcy or other problems in life, the Fed magically has the printing press. And they could literally just paper over everything. I don't know who you're talking about, Diana. Sorry. Oh, thank you for the super chat, Justin. I appreciate it. So from the different comments that have come out in the last month from different Fed governors talking about whether it's the Fed balance sheet or the shadow banking market with leverage loans or the CLOs or the corporate bonds or inflation or the dollar or interest rates too low for too long or the yield curve going inverted again or the Fed balance sheet. All these things, these are things that the Fed is having to worry about because the political system here in the US, Congress, broken. Voting system, broken. People want to vote themselves $50,000 or more in student loan bailouts. Do you think that's right? If you worked your butt off to either have no student loan debt, you worked a job through college, or you busted your butt to pay off your student loans, or your parents helped you out, do you think that's right? No, it's not right at all. The division between people is only going to get worse here in the U.S. I hope I'm wrong about this. I really hope we don't have a civil war, but it's the mistakes that are being made with the political system and people voting themselves more and more freebies, more and more bailouts, politicians promising them more. This is not going to end well. The divisions on race, class, gender, age, and then there will be a new division. People who get a bailout for student loans and people who don't. That's a new division. It's another one I wasn't even thinking about. Matt says divide and conquer. Yes. This initially was the Soviets' plan. This was their plan to collapse the U.S. from within. Now, the Soviets collapsed first. But this was their plan decades ago. They funded a lot of these groups, and then these groups, once they were seeded and planted, these groups grew on their own. Is the Fed now outdated? I hate central banks. They all suck. All governments suck too. Is the Fed now outdated? Central banks are awful. They're evil. They're engines of socialism and big government and big corporations and cronyism. And they redistribute wealth like crazy. So is the Fed outdated? There should have never been central banks in the first place. Central banks were in the past, they were for the king, for the treasury to steal. So I don't think that outdated is, I don't know if that's the right word. They're engines of evil. They're engines of wealth redistribution and evil. With negative rates, the Fed has no power. I don't think we can say that because the European Central Bank is doing all kinds of crazy stuff with negative interest rates in Europe. Look at all the bailouts they're doing to over-indebted governments. The governments in the European Union don't have to cut back on their budgets. The market is not pricing risk properly for Italian government debt and Italian banks because they expect the European Central Bank will buy that stuff back. You have American corporations taking advantage of this scheme with the European Central Bank buying back bonds. They issue bonds in Europe, and they know that the European Central Bank will buy them. Manny asked, but how could the governments fund the wars without central banks? Exactly. No welfare or warfare or big government without central banks. No bailouts. Most people don't even know what the Federal Reserve is. Most Americans on the street are so busy trying to survive or make sure they don't get fired at their job or put food on the table or keep their head above water on their bills. Or on dating apps trying to find a sugar daddy or sugar baby or something. Or sugar mama. I hear that's getting common now. Does the Fed have less power with negative rates? So I don't think all these governments can do negative rates at once. I already discussed this. It will break economic calculation. If all these governments go to negative interest rates, it will break economic calculation. Why? Because Howard Marks, famous value investor, Oak Tree Capital, Everything is based off the 10-year U.S. Treasury yield. So if you have a negative yielding 10-year Treasury, your discounted cash flow analysis, which allows most businessmen to do economic calculation, to do projected cash flows, discounted cash flows, those are broken. No, I have not changed my mind on Tesla. I don't care where the stock price goes. Accounting fraud is accounting fraud. And I've never shorted it, but I would not touch that thing. Congratulations if you rode that thing up. Don't be Isaac Newton. Don't ride the South Sea bubble all the way down. IMF will bail out central banks with SDR, except the IMF is tiny. And the Fed and the American taxpayer and the U.S. government fund all those agencies, the World Bank, the IMF, the United Nations. So how is the IMF, with no balance sheet, going to do that? And there's a fight among nations about control for that. At the United, for power, for seats of power. Who gets how much power in that stuff? So no, I don't think the SDR will win. Things are heading back towards nationalism, not globalism. We're being divided on nationalism levels now, not globalism. If the globalists were winning more, the SDR would be more likely, but things are headed with Trump and other politicians back towards more nationalism. And that's why we have tariff wars, and that's why we have trade wars, and that's why we have countries doing currency wars. If the 10-year U.S. Treasury yield goes negative, it will break economic calculation. All people's discounted cash flow models will break. Because there is no risk-free return then, supposedly, to discount your cash flows against. Negative interest rates also very good for gold. Central bank balance sheet expansion also good for gold. Inverted yield curve also good for gold. That's why a lot of people who are not gold bugs are accumulating gold on every dip. I haven't been paying much attention to Kirkland Gold recently, Taylor. I didn't see if the acquisition has gone through yet. Supposedly, for the last I heard, the board members at Detour Gold wanted it to go through, but I'm not sure what most shareholders supported. There was even a Bloomberg article a few days ago. Oh, it was about yield caps. Yeah, that was the other thing. The other thing was yield caps that I wanted to talk about. I didn't write notes down for the show because I might do another short video later. I have to get that China bailout video out. I just have to record the audio. The slide deck's done. So I've been covering yield caps about the Fed. If interest rates were to spike, the Fed would just start capping yields. They'd go into the bond market, monetize more debt, and start buying the bonds more to lower the yields, which is what Japan has done. Are yield caps or Japanification? Gold mining? Isn't Ivanhoe a base metal miner? They're not a gold miner, are they? Aren't they copper or iron ore? The limiting factor is American citizens, pitchforks, and torches, and how much foreign governments will take. In theory, the Fed could bail out the entire system again. In theory, and Roberto Perli, who is a former Federal Reserve economist, he works at a hedge fund now, pay attention to his comments. He did a very interesting interview for Forbes in December. I've talked about this. And he was talking about how the repo problems, the international repo problems, and the global dollar shortage because of too much dollar-denominated debt, he thought that the Fed would eventually have to bail out the entire system again. All these foreign banks, foreign governments, foreign central banks, foreign corporations with massive amounts of currency swap lines. He was saying that over a month ago. Yeah, Vajra, thank you for the super chat. I appreciate it. I have not looked at in-depth at Ivanhoe recently. And the gold mining company, I don't know offhand. I focus most of my time on the royalty and streaming companies. I occasionally look at some deals for some of the miners, the larger ones like Kirkland Gold. I did that as a bonus for my Patreon account contributors. Oh, and by the way, I'm almost up to 250 Patreon account contributors. I had a lot of signups. There's a 20-minute audio podcast behind the paywall there for the uranium market. If you're interested, there's a lot of good analysis in there. Also in the comment section behind the paywall. RR says Japan's had stagflation for 30 years. This is insane. I totally agree. And on top of that, the Japanese government claims that there's been no inflation and that they're fighting deflation. Japan has a demographics problem because they don't allow a lot of immigration. So they have mostly a homogenous society. So they don't allow a lot of foreigners in for immigration. They have some, but not a lot. And the other thing about Japan that most people don't know, and you'd have to know this by being friends with people who live there or reading a lot of articles about Japan, is the amount of taxes that have been increased in Japan on the Japanese citizens. So while the Japanese government and the Japanese economic data are screaming deflation, right? The taxes being layered on for the standard, these taxes being layered on all across many different items in Japan are nuts. The value-added tax keeps going up. There's been a number of increases in the VAT tax, the value-added tax, and a number of other taxes. And the portion size, so there's been shrinkflation there, which is part of stagflation and tax and lie, shrinkflation for reduction of portion size of foods. And the amount of taxes that the average Japanese citizen is paying is nuts. Oh, I'm very long-term on Sandstrom Gold because they have a lot. This is just my opinion. They have a lot of growth in the pipeline already paid for. And they have a good amount of free cash flow coming in. They're going to be able to do even more deals. They have some warrant money, a substantial amount of warrant money coming in by the end of this year, too. Another about $94 million in warrant money. And they're going to be able to reinvest that warrant money into even more growth. So the future is very, very bright for Sandstrom Gold. It's a cash flow growth machine at this point. So as long as the management does not over-leverage the balance sheet with too much debt and do a stream of bad deals in a row, there should be a lot of good diversified cash flow added to the growth. Basically every year now. They have enough cash flow where they can grow every year. American Expat says there is no price discovery with gold. I agree. The paper price markets are a joke. If they hadn't risen from 1,200, the miners would be looking at bankruptcy now. Yeah, so yield caps are a form of policy tool, what Japan has done. Because Japan has been doing so much tinkering, so much intervention, that at this point, Japan cannot even afford a 1% increase in interest rates. Japan has that much government debt. So they have so much government debt that a 1% increase in interest rates in Japan would take up all of the government's budget and the annual tax revenues. Jonathan asked, do I think gold miners are the most undervalued companies on the stock market? Yes, they're one of the few sectors. But you have to be careful. If you don't know which gold mining companies to pick, you can lose a lot of money. So while gold goes up, the management team of the miner can screw up the balance sheet. They can do a bad acquisition. They can have production problems at the mine. They can dilute you as a shareholder like crazy and prevent the stock from rising. There's a lot of problems at a mining company that other companies and other industries do not have. So if you buy an individual mining company, again, this is not financial advice, just my opinion, you have to be very careful If you pick out the wrong mining company, you can lose a lot of money, and your shares might not go up that much or at all. You could drastically underperform other gold miners. So yes, gold miners are undervalued. Uranium is also undervalued. Vajra, who was looking at my Patreon, thinking of signing up to my Patreon, behind the paywall, funny you asked that, behind the paywall on my Patreon account, there is a new 20-minute audio podcast about the uranium market. So uranium is one of the most undervalued sectors. It is absolutely hated. And so if you look at uranium companies, the PE ratios are not going to look cheap. It's on a net asset value, because a lot of mining companies are valued normally on either net asset value multiples, cash flow multiples, or free cash flow multiples. Normally, the industry uses one of those three valuation metrics. It depends. Most of the CEOs and the mining analysts covering them tend to use a net asset value multiple. So either there's a discount to net asset value. So some of these uranium miners will be selling below book value. They will sell at a discount to net asset value because of all the risks in the uranium industry. With nuclear power, post-Fukushima, here we are 9 years later. So they will sell at a discount to net asset value. And if things are right, then they will, in the future, and the market reprices, and there's more nuclear power plants built, and there's hopefully not another Fukushima accident. Although I talk about this behind the paywall there, I think the risks are fairly high that there could be another Fukushima accident because of how many corners were cut and construction defects for nuclear power plants in the 60s and 70s in California and Japan. From speaking with experts, you can listen to more of that behind the paywall. So eventually, if those net asset value multiples, if they go from a discount to net asset value, and then they get re-rated to a higher multiple above 1 times net asset value, that's when you get your 2 baggers, 3 baggers, 4 baggers, 5 baggers, 6 baggers, etc. Pudenda says she thinks Barrick Gold looks good. Given Barrick Gold management's track record, I don't really trust them. So if you have some short-term trading profits on Barrick Gold, congratulations. Me personally, this is just my opinion. I don't like the management team. I don't like a lot of the mines they buy, and they have a very bad history of not running mines well. Also, they were definitely lying about their production costs. I showed that with math a couple years ago in a video. They were telling everyone their production costs, all-in sustaining production costs were like $700 or $800 an ounce, and I showed they were closer to $1,200. I spoke to one of my top China sources who's in Wuhan. There's some very interesting things he told me. There's a lot of misinformation out there. I may do either a video update here on the free, or maybe I'll do an audio one if I get enough information. He's given me quite a bit behind the paywall on Patreon. We'll see. I'll think about it. Scott says, watch the engineers and computer scientists not get the student loan bailouts because they, quote, need it less. See, Scott, this is what I'm talking about. Politicians and bureaucrats picking out winners and losers. It's going to create more division, more resentment, more anger, more jealousy. If you had to bust your ass through college and you didn't get a bailout, and you know your friend smoked pot, snorted coke, banged hookers on credit cards or whatever, and with his student loan money, or his parents, were paying him under the table or whatever. There's whatever scheme he was running. Maybe he's doing drugs. And then he did all this irresponsible behavior, and he got a bailout. This is only going to make society more divisive. This is only going to make things worse. Ticket Sleuth asks, how long till people run out of food in Wuhan? That's a great question. So actually my source just said that the Chinese military and government is actually allowing food trucks in each morning into a large wholesale food marketplace. So they're not going to run out of food as long as people have cash to go to the market. They are allowing some driving, so there's not a full car ban, but it's mostly medical vehicles and military on the roads. So there's some private traffic. That's what I've heard. So people, if they have cash, I don't know if there's any problems with the banks in Wuhan, but it seems, I haven't heard anything about that for now. I can ask. But it seems that the Chinese government and Chinese military are allowing food trucks to go in and out. But there's a real mess from what I'm hearing about the testing. So that the Chinese government temporarily ran out of virus testing kits for a while. So the infection numbers may have been totally made up. So the increases may have just been a guess. But apparently, from what I heard, that it was only temporary that the infection test kits in Wuhan ran out, and now they're back. That's what I heard. I just heard that a couple hours ago. Omicron, I did not say that anyone who gets a student loan is messed up. I had student loans. I didn't have a lot of student loans, but I did have student loans. What I'm implying is that if someone was a fuck up and they did get a bailout and the other person who had a student loan did not get a bailout, it's going to create more division in society. That's what I meant. This is a good question. Super chat from Wally. What do I think of the yield curve reinverting? He thinks this is the first time this has ever happened in such a short time. I think the Fed's telling people that as of now that they are not going to cut rates for 2020, but I think the Fed would change that within a week or two to the next Fed meeting, and the Fed would cut rates quick. Vajra says he's a Patreon account contributor now, and I think that's why I just got beeped on my phone there while you're hearing that. So that beep was the notification that I just got it. Thank you. I appreciate it. Yeah, so I think the Fed does not want an inverted yield curve, and I think they are willing to cut everything. But if they cut everything, that's only going to make things worse with more moral hazard. Every time the Fed cuts, the behavior of market participants is they borrow more. The more the Fed cuts, the worse things can get. I would love pain now. That would be deflation, but they're not going to do that. So the more the Fed cuts, the worse in the long term things are going to get. I did do part of that a couple days last week, actually. Ableasdale 2000 says you should do a video on HSBC and other banks in the dead bank zone. It's bank analyst Christopher Whalen who did that, and I talked about that over the weekend in a short video with Kyle Bass and Christopher Whalen talking about HSBC Bank. And I've been covering some of the rumors that Kyle Bass has been talking about with HSBC Bank since over the summer. So I've been covering videos like that. You can look up HSBC Bank in the archives on my channel. There's about 4 or 5 different videos. The World Health Organization, they're bureaucrats. The Chinese government in all levels, the local politicians, the provincial governments, the local politicians in Wuhan, and the provincial governments in Hubei, they've screwed this up royally from the stuff I've read and from speaking to my source in Wuhan. This thing has been screwed up really bad for weeks. The first couple weeks that the coronavirus was starting to get going and some people were getting infected and seriously sick, any journalist in mainland China who brought this up was arrested. So we only found out about this weeks after it started. They arrested the journalists who were trying to get the government to help, who were warning people. The Chinese government cared more about saving face and covering up and protecting themselves and making themselves look good. Anthony asked, do I think these leveraged and inverse ETFs will be banned? Heck no. Wall Street makes a lot of money off suckers. Why will they be banned when you can go to the casino and lose your money fast? When you can put your ball on the roulette wheel, spin it, and lose it in a minute or two? There's no way Wall Street's going to get these things banned. The lobbyists on Wall Street are never going to allow that. What? That's funny. You got a letter from Fidelity saying they might ban them. Wow, there's actually people fighting for the retail investor? I'm shocked. There's actually people consumer protection? I'm shocked. Yeah, in general, I don't like the leveraged ETFs. Now, if you're a day trader and you know what you're doing, you can make money trading them, but the average retail investor doesn't know what they're doing and ends up losing a lot of money on them. Yeah, I mean, these leveraged ETFs are designed for day trading, so if you buy and hold them, you can lose a lot of money very quickly. The World Health Organization is owned by China, but China's been clawing into the IMF and the World Bank for a while. There's a lot of Chinese higher-ups there. Okay, guys, my voice is starting to go. I think that's it for tonight. So bottom line is the Fed is getting worried. I've covered this about a lot of different things. The yield curve potentially inverting again, the Fed balance sheet. The Fed is telling people that they don't want the balance sheet, the official balance sheet, to grow too much too quickly. So that may be why there's a big lag here with the Fed's official balance sheet not showing those term repos that are being added, because we should have another $60 billion in Fed in not QE added soon for the U.S. Treasury purchases, and then those term repos should have been added. So we should have the balance sheet. The balance sheet should be over $4.2 trillion soon. It should have been over that already. But if it's not over $4.2 trillion officially in the next couple weeks, then the Fed is not showing us anything at all on the repo stuff. They've just decided not to show us it anymore. Okay, but the bottom line, again, wrapping this show up, and thank you very much to my over 250 now Patreon account and monthly PayPal contributors. The Patreon's not over 250, it's total, Patreon and PayPal. Hopefully it'll be over 300 total by the end of the year. Thank you very much to people who tip me once in a while. I do take the top 6 crypto donations. Again, bottom line is that the members of the Fed are publicly talking now about all the different things that they're worried about, and there's a lot of them. And when they're worried about this many things at the same time, they're going to make even more mistakes. Now, when you have the world reserve currency, when you have a printing press, when you don't even have to print the money anymore, when you have digital dollars, you can paper over all your mistakes. So when the Fed and those stupid dot plots that are always wrong with their interest rate projections, like when the Fed was raising interest rates and then they were telling people that in 2019 they were going to do even more rate hikes, and then by summer they were cutting rates to uninvert the yield curve, that was a 180. They were totally wrong, and they had to panic and do a 180 because of the yield curve, because they were worried that the inverted yield curve was flashing recession. Oh yeah, we need to audit the Fed. The Fed should be independently audited all the time. But I don't think they're ever going to allow that. Ron Paul worked his butt off to get a one-time partial Fed audit that a lot of people on Wall Street want to pretend never happened. I even know libertarians and Austrian school people that want to pretend it never happened, or they don't know. Maybe they're too lazy to look into it. No, Anthony, the Fed doesn't care if they're wrong, because the Fed says they're trying very hard, and a lot of people at the Fed make 6 figures and they can't get fired for mistakes. So you literally have people here with the job security of someone at the Department of Motor Vehicles who are getting paid a lot of money with cushy retirement plans and Cadillac healthcare benefits, and they're getting paid a lot more money than DMV employees, and they have the level of track record of success of people at the DMV. But when you have the world reserve currency and digital dollars and currency swaps and all these fun emergency liquidity programs that you can just rename to fool people, you can get away with your mistakes. It's easy. And then you just blame it on capitalism. And then most people are not paying attention or don't understand what's really happening. They don't even know what the Federal Reserve is and what it does or who runs the Fed. And that's why we're in this situation. The people in power, the economic and political elites, have set up a system where it's heads we win, tails you lose. So when things go bad, capitalism gets blamed, even though central banks have nothing to do with capitalism. And big government and large corporations in bed with big government, along with the central banks, and have nothing to do with capitalism. But capitalism gets blamed. I see it every day. Okay, bye for now. Thank you, everyone, for listening.